Hello and welcome to Niaga Spotlight with me, Tehmina Kaoosji. Niaga Spotlight goes to the week in business and future affairs. Market watch, industries, analysis and insights. We've got you covered right here on Niaga Spotlight. Well, today on analysis, of course, we're taking a deep dive into Budget 2025 highlights. Now, Budget 2025 was, of course, tabled just last Friday by Prime Minister Anwar Ibrahim, who's also the Finance Minister. And it actually entails a 421 billion ringgit allocation with 335 billion in operating expenditure and 86 billion going towards developmental expenditure. Now, titled Reinvigorating the Economy, Driving Reforms, Prospering the Rakyat. Budget 2025 aims to protect the interests of the lower and middle income categories as well as the bottom of the high income group, dubbed the 85% as opposed to the so-called T15. Now, of particular interest, several tax incentives were put forth. This includes exemptions and relief, wider scopes, extensions of existing incentives, and all of these are aimed actually at furthering the development of sectors such as health and education and the Rakyat's welfare. Lavindran Sandragasu, who is tax partner with PwC Malaysia, joins me now to discuss Budget 2025 highlights and how exactly it may impact and shape the year ahead for the Rakyat and key sectors. Lavin, good afternoon. Thank you so much for joining us. How are you doing today?
Good afternoon, Tehina. Good.
Fantastic. So let's get the discussion started off, Lavin, with looking at tax first. And how do the expansion of reliefs for personal income taxes proposed under Budget 2025, in your opinion, highlight the Madani government's commitment towards the Rakyat?
Okay. So I think that's a good question because it's going to impact the man on the road. So there's been a couple of incentives or reliefs that is sort of designed for new initiatives, like for example housing loan, right? This initiatives has been given in the past for many years now. So there is housing loan interest relief, right? When taxpayers purchase a certain value of a house, up to 500,000, the relief is at about 7,000 per year, and between 500,000 and 750,000 in terms of value, the tax relief is about 5,000 per year, right? So this is quite new because back then, initially when they introduced this was in 2010. So we are like almost 14 years since this initiative has been implemented. So I think this is quite welcoming. And also the sale and purchase agreement or the effective period where this whole relief starts is from 1st January 2025 up to 31st December 2027. I think, as we all know, the housing market, requires a little bit of encouragement, and also to get people, purchasing more houses, because I think there's been some level of reduction in purchases of new houses compared to renting out. So I think this initiative is quite useful.
Absolutely, completely agree. And hopefully this will help to further boost the housing market come 2025, of course. Moving ahead into looking at employers in particular, Lavin. Now, how might the tax incentives under Budget 2025 be structured to perhaps specifically support employers who are implementing policies that promote work-life balance for female employees, and also hopefully moving towards increasing female LFPR, which is also part of the Madani government's commitment to increasing it to about 60%, a 4 percentile increase, hopefully within the next few years?
Yeah, so I think women coming back to the workforce is quite important. Yes, you're right. I think the current LFPR is about 54%, and so there's a move to move it to 60%. I think we do have currently some incentives already available for women returning to work. There's a 12 months exemption in terms of the remuneration received. But what has been increased this time around is that the employers who are, sort of employing these women back, they get an additional 50% of a deduction for the period of 2025 to 2027 financial years when they employ these women back to work, right? So This is over and above the 100% that they already get based on salary deductions. This is an additional 50%, right? So I think that's quite encouraging. The second thing is in terms of flexible work arrangements, particularly when it comes to capacity building, using of technology, acquisition of software, there's 50% deduction also, additional deduction provided up to a cap of 500,000 per year, right? So I think these two initiatives are quite important. I wanted to also add another point in terms of women directors on boards, right? So I think one of the comments that was mentioned by Prime Minister was that there seems to be room for improvement. So I think particularly in the public listed boards, he sort of feels that there should be a lot more women who sits on these boards. And I think there is some introspection that is required by some of these entities to make sure the threshold has been met. And I think he's quite serious about that point.
So pretty encouraging on that front at least. And also I'll just quickly point out that employers will also be able to provide additional 12 months paid leave for employees who are caregivers for children or sick or disabled family members. And this, of course, is a lot more inclusive than before because it's not only earmarking women as caregivers, but employees in general. Thank you. Thanks, Lavin. Moving into dividend tax now. Now, how do you feel the dividend tax will impact individuals, and what are potential impacts that the stock market may also foresee?
Okay, let me touch on the stock market for a second.
Sure.
What we need to also understand this dividend tax against the backdrop of, at least let's take a look at the public listed or the stock market itself, right? How much of that percentage is owned by individual shareholders? Because if you look at the Malaysian stock market, a sizable chunk of, in some instances, more than 50% is owned by the likes of EPF, PNB, KUAP, who are institutions, right? Of course, this dividend tax does not sort of impact these organizations, right? Then you have the foreign funds, foreign institutional funds, foreign investment companies, right? That also invest into the Malaysian stock market, and they can range between 10 to 20%, right? So then you, of course, have the unit trusts of the world, etc. So the percentage of actual individual shareholding in the Malaysian stock market may not be very, very significant, right? So from that perspective, I don't think there's going to be a severe or substantial impact to the stock market in terms of share price, etc. I think you can see that also from the recent days post the introduction or the proposal of the budget. I don't think we see huge changes. Now, coming back to the point about how it's going to impact the individual. So the threshold that has been set is once you earn dividends of more than 100,000 ringgit is what you need to apply the 2% tax on, right? So this is slightly different from some of the other countries where the tax is withheld by the company who is distributing, right? But in Malaysia, currently the way it's being proposed is that the individual would have to tax it in his tax return, his or her tax return, right? And so if you take 100,000 dividends per year, and if you look at about a 5% return in terms of dividend, you must be holding at least 2 million worth of investments, right? So that is also another barrier that you have to pass, right? So it would not impact people who earn less than 100,000. So like, for example, some pensioners, the argument may be that this is their only revenue source, for example, right? So of course, if it's below 100,000, then there's no tax to pay, and the tax is on basically 2% of the dividend income that you earn, right? So I think on an overall, it's targeting the high net worth individuals with investment sizes above 2 million, right? In terms of capital being invested, and I think in terms of stock market, I think there should be minimal impact in terms of this dividend tax. And by the way, sorry, just to add, right, our neighbors like Indonesia, Thailand, Vietnam, all have implemented a dividend tax. And their rates are much higher. It's about 5 to 10%.
Yes, indeed. And that, of course, ultimately hopes to diversify the government's tax earnings and also lowering its dependence on salaried taxpayers. Thank you, Lavin. Moving into the global minimum tax, now Malaysia will also be finally enforcing our GMT from early next year. So are there any broader, more targeted recommendations from PwC's side to ensure that the impact of the GMT and preparation will actually be efficiently rolled out?
Okay, so, this is more for the listeners, right? The GMT is undergoing constant change. I think that's the term that we use within the fraternity. The rules keep changing because it's a global initiative, and even globally, not all the countries have started implementing. Malaysia is going to start implementing from 1st January 2025. And a lot of companies are also trying to figure their way out through this. There are a lot of, impact in terms of your financial reporting, your audited statements. There are some implications in that are still being discussed. So I think the point here is the rules are still, being discussed, and it's subject to modification, right? I think one of the initiatives that was suggested in the recent budget or proposed is that there's a sort of a refundable tax credit that is being thought of. And this is something that some of the other countries, as well as the OECD, has recommended in order to provide some level of support to countries who are impacted by this global minimum tax, right? But the point here, it's called refundable tax credits. And so being refundable, there's a period in which some of these, if you can call it grants, it's akin to a grant, needs to be returned back, to whoever you are receiving it from. So I think these are some initiatives taken to reduce the impact of global minimum tax, right? Because global minimum tax can affect companies who are below the threshold of 15%, and you have to pay a top up, right? That's the simple logic behind it. And if you sort of have to make that top up, it results in a cash outflow, right, for companies. So this tax credit is supposed to mitigate that. So and Malaysia being a very, there's a lot of tax incentives in Malaysia, not only for individuals but corporates as well. So I think these are some of the areas that the government is looking at.
Absolutely. And of course, just to highlight very quickly that, of course, the first GMT filing is only due 18 months after the end of the first financial year, which will be next year itself, but gives plenty of time for corporations and smaller companies also to be wholly prepared. Thank you, Lavin. Moving into a couple of pointers from Budget 2025 which regard the Rakyat. Let's look at social safety nets and what specific initiatives under Budget 2025 are clearly aimed at strengthening social safety nets for our vulnerable populations and also improving overall quality of life for Malaysians. Okay, so
as you mentioned, I think the cost of living is paramount. I think a lot of impacted parts of the society continue to require some level of support. So I think in terms of the social net, we do have the Rama initiative, cash initiative, or also called as STR. Now that has been increased from 3,700 per year to 4,600. The allocation for that has also increased on an overall basis because we have about 5.4 million households covering B40, parts of the M40, the poor, as well as senior citizens. So this social net is, has been increased to take into account the cost of living increases as well. And I suppose we will touch upon it at some point in time during the course of our conversation in terms of the subsidy, relaxation or restructuring. And so I think the government is anticipating that. and I think they've increased that aspect of it. I think there's also a couple of other aspects that they have increased. I think there's a lot of care being taken in order to support the lower income groups, in order to ensure they're not severely impacted by price increases moving forward.
Absolutely. And overall, it's a 15.9 billion ringgit allocation to assist those hardcore poor, as well as specifically the lowest income families will be able to receive upwards of at a maximum of 13,000 ringgit in financial aid annually. Moving into education and skills development, Lavin. So how could the allocations for this in Budget 2025 address gaps in workforce readiness in particular and ensure that Malaysians are equipped for future job markets, particularly in emerging industries, which have also seen plenty of FDI flowing into Malaysia, but now it's all about ensuring we also have some domestic workforce who can make up those numbers?
So I think this issue is continues to be on the table, right? Because I think the main matter that needs to be sort of discussed and decided upon is that skill gap between what demand is from the corporates and businesses versus the supply aspect of the workforce itself, right? So the skill gap is really critical. Now, of course, the budget for the education ministry has been also increased, together with the healthcare ministry as well. But again, it goes back to the skill set itself. Now, of course, things like TVET, the vocational training aspects of it, budgets has also been increased. Again, the demand side of things, which is more looking at AI, which is more looking at the semiconductor industry, in terms of engineers, but also the relevant type of engineering skills that is required. There still seems to be a gap. Now, how the government is able to support, private education, public education to meet this demand is going to be critical. I don't think we really have an answer or a silver bullet in relation to this matter, because I think it involves a wide range of stakeholders. It also goes down to effectively the mindset of the people or the workforce coming online to support the economy. So I think there's a lot of factors involved. You can't really pinpoint on one particular factor to say this would change the whole scheme of things. But again, I think the direction is there. But I think implementing this is going to be a big challenge.
Absolutely, agreed. And of course, just to highlight that the figures are previous year's budget, it was 6.8 billion ringgit allocation for TVET. This year, it is 7.8 billion ringgit under budget 2025. Moving into looking a little closer at subsidies, Lavin. Now, what are the potential economic and social implications of the proposed reforms to, in particular, fuel and food subsidies under budget 2025, especially in relation to inflation rates and how it's going to impact day-to-day cost of living for our lower income households?
Okay, so maybe just to provide a little bit of context, I think as we all know, there's some subsidy rationalization has already taken place.
That's right.
So I think even in the budget, Prime Minister mentioned that there's about 4 billion worth of savings in terms of the subsidy for diesel. There's another 4 billion in terms of subsidy for electricity, and another 1 billion for subsidy for chicken, right? So I think there has been subsidy removal that has taken place now, and I think correspondingly there's also price increase. I think that's an inevitable situation. But I think as we spoke about earlier, the support, the social net has also correspondingly increased to take into account this subsidy rationalization. Of course, Prime Minister also mentioned that next year, second half of next year, the RON 95 is going to be readjusted, right? The subsidy rationalization for that. But I think he made it clear that it would generally impact only the top 15% of consumers. in relation to that subsidy rationalization, and the balance 85% should not be impacted by the subsidy rationalization. And I think now they are fine-tuning the aspects of that. So I think coming back to inflation, so I think inflation is hovering around the low 3.1% currently. So I think even if there's some price increases, it shouldn't be significant changes to inflation. So I think that should be still a manageable range that Malaysia as an economy can sort of play within. So even though, because generally if there's inflation increases significantly, then interest rates would sort of be used to sort of reduce the inflation, right? So I think that's a balancing act that we need to do. And of course, there's no suggestion of increase in interest rates as well. So that's a good thing. But again, I think there's still insufficient fiscal room in order for inflation to move up slightly, a couple of basis points maybe, with this subsidy rationalization without adversely affecting the economy.
Indeed. And of course, the inflation rate for Malaysia is at least forecast to increase anywhere between perhaps 2.0 to 3.5% in 2025. As we're moving through the conversation, Lavin, let's spend a little bit of time before we end out on the oil and gas industry. I would really like to ask you, in your perspective, how can the government balance its revenue projections from the oil and gas sector for budget 2025 with the potential volatility and continuation for global oil prices, and what contingency measures might be recommended to address any significant price fluctuations?
So a tough question, Tehmina. So a couple of aspects, right, to consider is that I think Prime Minister also mentioned the amount of tax collection from the petroleum industry has fallen to about 20 billion. I think it was much higher the previous year. Of course, to a large extent, it's to do with the oil price as well, comparing year to year. Now, I think for this particular year, the oil price has been averaging around $85 per barrel. So I think so long as that price range is sort of maintained going into next year, I think collections should still continue to be, remain in a good position as far as tax collection is concerned. Now, of course, price fluctuations, there's so many incidences, geopolitics, interest rates in the US, gold prices. There's so many things that play into this. I think one aspect that we also need to consider is the energy transition. So, I thought maybe we'll just touch on that, because that's also a key indicator. And I think there are certain commitments that has been made. And in the recent budget proposal, the government has also suggested a little bit more focus on the carbon capture, utilization and storage. So I think there's going to be more, firmed frameworks, how to implement some of this. I think Malaysia has got a fair amount of storage capacity, about 2.4 gigatons of storage available, and that can be utilized by, various industries like power and industrial emitters of CO2, right? So there's a lot of other initiatives that need to be thought of as well, and moving away from the energy transition to less of fossil fuel versus more renewable sources also requires a lot of capital investment, right? And of course, when you need to get companies to incentivize them to move towards that. And also tax collection may to some extent be impacted by that as well, right? In an indirect manner. So I think the strategies, because we are also looking at energy transition, when you compare that versus the oil price fluctuations, I think that's something that we have to live with, right? And I think as things changes, I think we accordingly have to fine-tune the various aspects in order to make sure that at least there's some level of stability in the economy. I think that should be the focus.
And clearly so, because especially since about 70% of the OGSE sector are actually SMEs, and they clearly require a lot more support to manage their resource constraints due to their size, what to speak of even transitioning into climate change and better energy transition measures. Moving on into environmental considerations, Lavin, in light of the increasing global emphasis on sustainability in particular, how do you feel Budget 2025 has addressed environmental concerns associated with oil and gas industry, particularly regarding carbon emissions and the push towards more renewable energy sources for us?
Yeah, so as I mentioned earlier about carbon capture, utilization and storage, so that's one aspect that the government is focusing on. I think there's it may not have been specifically stated in the budget, but in the National Energy Transition roadmap that was introduced a couple of months ago, there has been quite a bit of initiatives on that side of things as well, for more renewable usage. That's one aspect. The other aspect is also carbon taxes. There is a potential introduction in the next year or so, and that would also sort of try to get companies to be more energy efficient in that manner. But of course, carbon taxes is particularly, sort of going to be impacting the energy as well as the steel producers at this particular moment in time. So it's going to be a very focused group that are going to be subject. But anyway, this group represents about 70 to 80% of carbon CO2 emitters in the country as well. So the focus group is right. So that's part of the National Energy Transition Roadmap. Carbon taxes has always been there on the table. So I think the initiative taken now is to really implement that moving forward.
Correct, absolutely. And additionally, there's also allocations such as the 300 million ringgit for the NETR, National Energy Transition Facilitation Fund, as well as about 1 billion ringgit for Green Technology Financing Scheme, the GTFS, until about 2026. Lavin, thank you very much. This has been a most insightful conversation with a particular focus on tax incentives and a couple of other key sectors for the Malaysian economy under Budget 2025. It's been a pleasure having you here with us on Niaga Spotlight.
Thank you, Tehmina.
Well, that's all we have time for today on Niaga Spotlight, covering Budget 2025 highlights and, of course, hopefully targeting a reduction in the nation's fiscal deficit from 4.3% of GDP in 2024 to 3.8% in 2025. I'm Tehmina Kaoosji signing off. We'll see you again next Friday with more business analysis and insights. Here's to a productive week ahead.